Martin Crabb is here.
A bit odd.
It's Tuesday.
It's Tuesday.
CIO of Shaw Partners. Martin, do you think that the lackluster performance of the Australian market, not just today but yesterday as well, can be put down to a bit of nervousness around COVID?
Yeah, I think more this hedge fund unwind.
You think
I think
so?
that's, yeah, people got very nervous about it because he's blown up no fewer than 5 banks, and 2 quite significantly, I think Credit Suisse and Nomura, big losses there. So you'd imagine, I mean, basically those banks were funding a guy who was squeezing shorts. So there's lots of people out there trying to squeeze shorts, including all the Reddit
But he
crowd.
was doing it using derivatives and leverage,
Yeah, and
in a
very
massive way.
very leveraged and very big. And I don't think each bank knew how big he was because I only saw a bit of his business.
Well, it's a bit like doctor shopping, isn't it? No one actually knew what the other banks were providing.
Yeah, and I think there might be a regulatory issue here in that how do we not have all these banks understand the full gamut of the commitment, and are there other people out there that have got this highly leveraged short squeeze strategy on that's also going to unwind? So I think the next sort of 24, 48 hours, particularly derivative markets, big quarter end, month end, as you said, financial year end in Japan, a lot of people square out the books, and maybe there's just a few people saying, yeah, we probably need to call a few of these margins in. So.
Well, and we saw the 10-year Australian government bond yield spiking today.
Yeah.
I think it was by 9 basis points. So that is likely to
Keep
do
people
a bit of
nervous.
damage. Yeah.
I think US Treasuries are up 10 as well. So
Which is not a risk-off environment, though.
Yeah.
In a risk-off environment, bond yields should be going the other way.
Yeah.
So it's not a clear message in the markets, I don't think.
No, it's not. So the bond markets are obviously still pricing in
Infrastructure
inflation.
programs?
Yeah, probably. So that's gone from 3 to 4 trillion now.
Yeah.
It's a $20 trillion economy, so $1 trillion is 2.5% of GDP. These are big numbers, right?
Yeah, no,
Big
it's
numbers.
a little frightening. Now, you sent me something which I thought was fascinating. So the 10% most expensive stocks have a PE above 54 and the cheapest below 8. That sounds huge
Yeah.
gap. What's the dynamic there?
The highest PE dispersion since we can keep records on it. So we're looking at stocks that have been in the index the whole time, so there's a little bit of survivorship bias. But this ratio, this PE dispersion, it typically spikes when markets are really stretched and really extended. And it's just about saying, if you've got some growth, I'm going to pay a heck of a lot more for your stock than if you don't have growth. So obviously in the Aussie market, we've got good examples of both. But we have some stocks on, a number of stocks on quite stratospheric PEs. If you think of all the tech sector, for example, I've excluded stocks that are losing money because they obviously have a bit of a perverse impact on PE ratios. But it is a very stretched number. So if you take that spread and divide it by the average, it's about 2.5 times. And that's the highest we've seen forever. It has come off a little bit this month because of the rotation out of growth stocks, but it's really just the growth value spread. It's really what's caused it.
Gosh. So how does that play into, like, everyone, ever since bond market blew up, everyone's talking about growth versus value. How does this play into that thing?
Yeah, well, a little bit is to do with duration. So if you've got lots of stocks where they're expected to make all their profits in the future and not today. So I think Tesla is a very good example, right? On a current PE, it's probably on hundreds of times earnings. So it's a long duration stock. You expect it to be dominating the auto industry in 20 years' time, sort of thing. So lots of stocks like that in the market, like we had in 2000, and also pre the GFC, we had lots of those high growth stocks. The bond yield compresses that. So the bond yield makes you lower the duration of your portfolio. So anything with long duration gets impacted by that valuation impact. So it starts to shrink the PE. So we're seeing the PEs at the top end of the market start to come down and ones at the bottom start to move up. So if you think of how well stocks like Telstra have performed, that's a low PE stock. If you think about the banks, they've performed really well, low PE stocks. The iron ore miners, low PE stocks. So all the low PE stocks have been getting a bid, but the long duration ones, your Afterpays and these sorts of ones, they've been underperforming, which is kind of narrowing that gap.
Now you
trade.
do mention Telstra there.
Yeah.
Telstra is splitting out its infrastructure business. We heard of that last week, I think it was. Today, AGL splitting into 2.
Yeah.
We have the demerger of the Endeavour business by Woolworths. What's happening here?
Yeah, I think that's as a segue from this PE dispersion into that behaviour. So if you're a portfolio of businesses and one's highly valued and one's not highly valued, can you create shareholder value by spinning off the one that's highly valued? So AGL have an operating company and a generation company, and not too many people want to own electricity generation, particularly if it's coal-fired. So that's dragging down the valuation of what their operating company is, which is all the customers and the billing and all that sort of stuff, and maybe even the solar schemes. If they can spin that off, they'll get a higher PE for that. So it's kind of arbitrage, but it's saying the market is willing to pay a lot for this business. Why don't I spin off the crappy part? So Endeavour Drinks for Woolworths, there are some people who don't like alcohol, right? It's an ESG kind of thing. So if they can spin off that asset, it's also a low growth business that's tied into poker machines, not really anything to do with supermarkets. So it's a non-core asset and they're better off spinning off. You got Tabcorp looking to sell off its wagering business because they've had some private equity knock on the door to say we want to buy it. Can they crystallise a greater value by separating it? And also Treasury Wine Estates did look at spinning off Penfolds. They decided not to. So I think, Nadine, these are a direct result of directors looking at the portfolio business that they have, saying, would this part of the business be worth more in another shareholder's hands? The mining companies are doing it for ages. You think of South 32, you think of Blue Scope Steel. In fact, if you go back far enough, Newcrest was part of BHP. It was BHP Gold. So Deterra and Iluka, so they've been doing it for a long time. So where you can see an opportunity to create shareholder value by spinning off a business, it makes a lot of sense to do it.
Do you have any feeling or any idea of what would be, the next cab off the ranks? What's a business that you would like to see crystallize some shareholder value by splitting up?
Oh, you're putting me on the spot there. I mean, I did like the Penfolds one coming out of Treasury Wine Estate because it's got some bulk wine businesses, particularly in the US, that are not great businesses. I think,
Treasury Wine's a good one because if we talk about that,
one,
especially in light of the news that's come out lately, when we've had a number of people say that Treasury Wine is looking good value at these levels, especially if they can strategic.
Because they're trying to be green, so maybe they could be, well, here's the old nasty oil and here's our green, clean.
I think if Twiggy gets his Fortescue Future Industries business up and running, if he does green steel and hydrogen and stuff, you want to own that. So in the market, we've got lots of clients who'd love to buy renewable energy. They'd like to buy a solar farm or a wind farm or anything, but the only one that was around was Infigen Energy, and that's been taken out. So you're right. If you've got a business like Origin Energy, which does have renewable, Snowy Hydro is another one that's renewable. So they'd be great assets to own by themselves, but they're stuck either in government or they're stuck in single assets.
We've had two gold explorers from Perth, WA on the program lately. Clearly, there's a lot of activity up there. It's the gold is in those hills. When it comes to gold as an investment, though, some of the bigger players in Australia, is it starting to look a bit more attractive to you guys there? Yeah,
I mean, obviously it's disappointed. I mean, it peaked at $2,800 an ounce Aussie back in August, and it's kind of $2,200 an ounce Aussie today. So that's a 20% odd fall, and it has, as that graphic there shows, it has followed negative real interest rates. So if real interest rates are heading negative, gold performs well. So that stopped happening in about August, and we started to see the vaccine, the US election, and the repricing of inflation, and negative interest rates have started to narrow. That's taken gold with them. They've probably gone. Gold's gone a lot faster than that trade has. So yes, real rates have narrowed a little bit. Gold is narrowed more, so gold's sort of probably about $100 too low on that measure. Our view is that there's not enough inflationary pressure in the medium to longer term to keep those real rates changing direction like that. So we think the gold price probably has a period where it starts to catch up again. So we're not saying, throw everything out and buy gold, but some gold stocks, because they've underperformed by so much, like Northern Star was $17, it's now closer to 10. They've fallen by much more than the gold price. So we think if there is a little bit of a turnaround in gold, that those things like Northern Star will do very well.
Yeah, it feels like a bit, not quite generational, but it does feel like the younger crowd are saying, oh, it's all about crypto, Bitcoin, digital, gold is old school.
Yeah.
But then you bring on some old school analysts who go, oh, this is just a sideshow, I'm with gold. So I feel like the market's really divided. How do you feel when you have these discussions?
Crypto is incredibly interesting, right? And because it's so complex and no one really understands it, it's great to talk about it. But I think as a store of value, gold's definitely got a much stronger role in portfolios than crypto does, because crypto's volatility is absolutely through the roof. and it's not really backed by anything, right? So it's
backed by Twitter.
It's backed by an algorithm and a whole bunch of speculators, right? Whereas gold is, it's sitting in vaults, and there's only a certain amount of it in the world, et cetera, and it is used as a currency and a store of value and that sort of stuff. So I think
I could play the whole Bitcoin devil's advocate, but I won't. I'll just continue on with
We're all
it.
a little sick of that argument, aren't we?
All right, Martin, look, we've got some Fed speakers tonight. We've got tomorrow detail coming through on a very potentially big infrastructure stimulus plan in the United States. That is likely to be market moving.
Yeah, I think so. And then don't forget payrolls on Friday.
Oh, yeah.
We're going to have 500,000 new jobs in America on Friday. It's going to be a big number. We'll all be eating Easter eggs and stuff at the time and eating hot cross buns. We won't be that focused. But I think, we're just setting up for an incredibly strong economy in the United States. We've already got the set up on the $1.9 trillion stimulus plan. Obviously, the place is reopening. Their vaccination's running really, really well. There's almost as many people vaccinated that have had exposure to the virus now, which is fantastic. So that herd immunity story is building very strongly. I think the US economy absolutely flies this year and driven by the consumer. So I think if Biden's more aggressive on the stimulus side, as long as he doesn't try to tax too heavily, because obviously they're talking about funding a lot of it through higher taxes. As long as that doesn't put people off, I think we could be, the markets could perform very well on the back of this.
And is it fair to say that you need a bit of a rest this Easter weekend because corporate activity here in Australia is keeping you pretty busy as well?
Yeah, well, I'm lucky because I sort of sit up in this macro strategy, so I don't get down and dirty with the deals. But a lot of my colleagues, it's just deal after deal after deal, which is great because it means the capital markets are open and companies are investing and drilling and taking each other over and all that sort of stuff. So it's good to see that activity, but I'm sure a few of my colleagues wouldn't mind putting their feet up for a couple of days.
Well, I hope you get a bit of a rest anyways. Everybody loves
Thank
a long
you.
weekend, especially when there's 2 in a row.
Yeah.
Sure do.
Happy Easter. That's Martin Crabb there. He is CIO at Shaw Partners.